Well, that disinflation that we're seeing creating more worries in the markets of a more hawkish Fed. Joining us with more, Omar Aguilar, Schwab Asset Management CEO and CIO. Good to have you on the show. I mean, as we've been seeing with all central banks, we're seeing this slowing pace of rate hikes, still seeing more work to do, apart from what we saw with the Bank of Mexico, their central bank actually going with a 50 basis point hike, which nobody really saw coming. But I mean, how far off are market expectations right now as to some of the risks that the Fed continues to highlight?
Well, it's a great question, and I think a lot of the uncertainty we see in the market, this morning being a great example, is investors are still trying to understand this big gap that exists between central banks and their fight of inflation and what the market expectations are. In the United States, it's very clear that the market still pricing the fact that there might be some rate cuts down the road. And what we heard during the week is from Fed officials is that they not necessarily feel that way. In fact, the tone of most of the comments, starting with Jerome Powell, is that there's still a lot of work to do, that they still see signs of disinflation, and it sees signs of potentially, continuing to see, pressures that will have them, continue to be fairly hawkish. And I think when you see this discrepancy in what the market expectations are and what Fed officials are basically telling us, we see that level of uncertainty in the market. What is clear is that what the goods inflation that we saw coming into last year, that it has started to come down. And, the challenges this year is that is not necessarily going at the same pace as we had before. The market got really excited because, they thought that was going to be good news. But all of a sudden now we see that some of those may actually have to wait a little longer.
I mean, and we did see Jamie Dimon telling Reuters, I think people should take a deep breath on this one before they declare a victory because a month's numbers looked good. I'm sure the Fed would echo that, obviously data dependent, not just looking at what they saw with perhaps a bumper jobs number, which did have some other issues with seasonality built into it. But I mean, how difficult does this make the Fed's position here? The market's either not heeding or believing them at the moment in terms of how aggressive they still intend to be.
Well, a lot of that depends on, the views that they have on the strength of the economy. And, we still have a significantly and very strong labor market, which, it's sort of starting to show some signs that potentially is going to crack, in the next, few months or so. But the Fed is basically saying that, they can continue to fight inflation as long as the economy will withstand it. And I think when you see those two components, the health of the economy and the data coming on economic, news, the good news becomes bad news for the market. And it basically supports the Fed decision to stay on track to keep going on fighting interest rates. We're in this cycle where tightening monetary conditions is something that will allow the economy to slow down. Now, I think the bigger question is the Fed feels very comfortable knowing that they can continue to press on the brakes without necessarily causing a major damage in the economy. That's still fairly questionable because normally, the tightening cycle takes between 12 and 18 months to have an effect in the economy. I think the bigger data point that most people are looking at is the inversion of the yield curve. When you see the 2 to 10, yield curve being, in a very, very negative territory that we haven't seen, for almost 20 years, that just basically shows that discrepancy between the short end that is controlled mostly by the Fed and the expectations that the market have about the U.S. economy.
And we have seen some of these macroeconomic issues still showing up in forward guidance in what's been a pretty mixed earnings season at the moment, especially when you look at corporate earnings for Q4. I mean, what should we be reading into the falling share of companies that have had an earnings beat? And I know you noted 69.3% versus a 76% average over the past 4 quarters. What should we read into that and how these companies are really gauging the outlook?
Well, earnings is the other, big, metric that we tend to look at and the trends that we see there. And it's a very clear deceleration of earnings. If you actually saw, most people were very surprised into the earnings results in 2022. But the majority of those earnings results and the majority of the percentage of companies that were able to beat their numbers, were as a result of the prices and the price control that they have by passing those through consumers. When we see that basically being stopped, and when we actually see that pricing powers stop for most companies, those profit margins become under pressure. And what we have seen so far in the results of the fourth quarter is that trend continues to get bigger. So fewer companies are beating their earnings, and not only that, but when they beat their earnings by a smaller amount, compared to what they have seen historically. So we're starting to see that big pressure that comes from inflationary pressures that still affect without them being able to pass those prices over to consumers, and at the same time, the labor cost increasing that puts more pressure. And obviously, not surprising, the result of that is a little bit more cost control and starting to just, go to layoffs and trying to reduce cost at all costs so that those profit margins stay, somehow in a good place. So it's sort of a transition quarter for earnings where we expect more of that deceleration going into next quarter, as we can see a little more pressure from labor costs, when we see, probably a little less demand on consumers and a less ability for companies to pass those prices over to consumers.
Yes, I think a transition quarter is a very good characterization of what we're looking at this season. Omar Aguilar, thank you so much. Schwab Asset Management CEO and CIO, thank you for joining me this morning.